Welcome to The Explainer. I'm so glad you're here today. If you're a focused learner looking to finally demystify how everyday people actually build wealth, you are in exactly the right place. We're going to completely bypass all that complex, intimidating financial jargon that Wall Street loves to throw around, and instead, we're going to break down the foundations of wealth, step by step. Have you ever wondered why people get so incredibly excited when the stock market goes up? Or why the financial news is constantly buzzing about massive companies like Apple, Tesla, and Amazon? More importantly, how is it that some people become wealthy simply by owning stocks? Well, the goal of today's explainer is to cleanly and directly answer what exactly stocks are and how they actually work. Okay, let's dive into this. Here's our roadmap for today. We're going to cover the secret to building wealth, what it means to own your favorite company, how the stock market actually works, the realities of making and losing money, and finally, we'll lock in the golden rule of investing. Let's get to it. All right, starting right off with Section 1, the secret to building wealth. There is this massive cultural mystery around how wealth is actually generated. A lot of folks think it requires some complex formula, a genius-level IQ, or hidden insider secrets. But the reality? It's not magic. It is simply ownership. Despite all those confusing buzzwords you hear on the daily news, the true fundamental base of building long-term wealth is just owning parts of real, functioning businesses. It literally is that simple. And once you grasp that, everything else starts to make a whole lot more sense. Which brings us to Section 2, owning your favorite company. To really picture how this concept of business ownership scales up from something super small to something massive, just imagine your friend starts a local burger restaurant. Okay, first, the business is booming. People absolutely love the burgers, and there's a line out the door every single day at lunch. Second, your friend realizes they need cash to expand. Maybe they want to open a second or third location across town. But instead of taking out a heavy, burdensome loan from a bank with crazy high interest rates, they choose a totally different path. They decide to divide the business into 10 equal pieces. They are choosing to sell off little slices of ownership to raise that much-needed capital to grow the business. So the crucial point here is understanding the concept of a share. A share is simply an equal piece of a business that represents partial ownership for the investor. If you buy one of those 10 pieces of your friend's burger joint, you literally become a part owner of that entire restaurant. If they become wildly successful and open up nationwide, the value of your ownership increases right along with it. On the flip side, if the business struggles to attract customers, the value of your investment takes a hit too. You share in the journey, the risks, and the rewards. And honestly, this is exactly, fundamentally, how stocks work. When you buy stocks, you aren't just trading random tickers on a screen. You are buying actual ownership. Okay, let's move on to Section 3, how the stock market works. We just looked at the local burger shop, but how does this apply to massive global corporations? Well, just like that small shop, growing any business takes money. Companies need massive amounts of funds to open new branches, develop innovative new products, hire thousands of top-tier employees, buy advanced machinery, or even expand globally in international markets. Instead of borrowing all that money from banks, which, let's face it, would result in mountains of debt, many companies raise this capital by selling ownership to everyday investors. It's a mutually beneficial relationship. The company gets the cash it needs to innovate and grow, and we, the investors, get ownership, hoping the company becomes significantly more valuable in the future. Now, what's really interesting here is the math behind it all. Let's anchor this with a super concrete example. Imagine a company is worth exactly $1 million. The owner decides to divide the entire company into 1 million shares. That means each individual share is worth exactly $1. If you buy 1,000 shares, you own a small, specific, tangible portion of that company. Now, let's say that company grows like wildfire over 5 years, doubling its profits and expanding its reach, and its total value skyrockets to $2 million. Well, the price of its shares rises right along with it. Each of your shares is now worth $2. Your investment just doubled in value. And if you choose to sell it to someone else, you pocket a very real profit. But where is all this buying and selling actually happening? It happens on stock exchanges. Think of these as giant global marketplaces where millions of shares trade hands every single day. You've definitely heard of the big ones, the New York Stock Exchange, the NASDAQ, the London Stock Exchange. Back in the day, this literally meant a bunch of people frantically shouting on a busy trading floor. But the amazing thing about the world we live in today is that investing has become easier and more accessible than ever before. You don't need to be some elite Wall Street broker. Everyday folks like us can buy and sell stocks directly from our smartphones using simple brokerage apps in a matter of seconds. It's incredible. All right, let's jump into Section 4, making and losing your money. It's time for a bit of a reality check.
We need to clearly outline how you actually pull profit out of the system, but also look at the inherent risks involved. Basically, there are two main ways investors make money. First up is capital appreciation. This simply means buying low and selling high. Like buying a stock for $50, watching the company succeed over a decade, and selling it years later for $80, earning a cool $30 profit per share. On the other side, we have dividends. Some large established companies will actually take a chunk of their profits at the end of the quarter and share them directly with their shareholders as cash payments. It's essentially a recurring financial reward just for being a part owner of the business, deposited right into your account. Pretty great, right?
However, we definitely have to temper our expectations here. Investing is not a magical one-way street to riches. Stocks do not always go up. Businesses can and do perform poorly. Sales might drop because consumer trends shift, competition could aggressively increase, or the broader economy could hit a really rough patch. When these things happen, the overall value of the company falls, and consequently stock prices decline right along with it. This is the reality of the market. Investing always involves risk. You can certainly make great money, but if the business you own a piece of struggles, your investment shrinks and you can absolutely lose money. So with all that risk involved, you might be wondering, why do people do it? Well, let's compare your options. Keeping your money in a traditional savings account gives you safety. Your money is insured, the number in the account won't randomly drop. But the returns are usually very limited, often barely keeping up with inflation. Your wealth isn't really growing there. Stocks, on the other hand, definitely involve risk and volatility. Your portfolio is going to go up and down. But historically speaking, they have generated much, much higher returns over long periods of time. That right there is exactly why so many people use the stock market as their primary engine to outpace inflation, build real lasting wealth, and set themselves up for retirement. Moving on to our final section, Section 5, the golden rule of investing. Listen, if you take absolutely nothing else away from this explainer today, you must understand this one critical lesson to protect your financial future. Never, ever invest all your money in a single company. I don't care how much you love their products or how certain you are they're going to succeed. If you put all your eggs in one basket and that company suddenly tanks or faces an unexpected crisis, your entire investment could be totally wiped out. Successful investors protect themselves by spreading their money across a bunch of different companies, different sizes, and totally different industries. This is called diversification. It is hands down the single best strategy to massively lower your risk while still getting to ride the long-term growth of the market. So, to really summarize our core philosophy today, stocks are not gambling. They represent ownership in real businesses. The stock market is not a casino, and it is for sure not a shortcut to getting rich overnight. It's about steady, consistent financial education and long-term participation. Remember, when you buy a stock, you're buying a real piece of a real business with real employees making real products. And when those businesses innovate and grow, you get to share in their financial success. Understanding this mindset shift is the absolute most crucial first step to making smart, confident financial decisions for your future. Before we wrap up, I want to leave you with a provocative thought. Look around at the businesses you interact with every single day. The stores you shop at, the incredible technology you use to communicate, the companies making the food you eat. If you look at them through the lens of an investor rather than just a consumer, what business would you want to own a piece of today? Just let that marinate as you go about your week. Thank you so much for joining me for this explainer. Keep learning, stay focused, and I will see you next time.